Good morning. I'm Allie Swafford, President of Prosperity Partners Wealth Management. We've had a number of folks direct their questions to me about, well, what does this election mean? Well, certainly in any election, there is an opportunity for policies to change, and boy, this is one that really could be true. So what are 4 smart planning moves that clients should consider, knowing that we don't know how November the 3rd will come out? But specifically, Biden's tax proposal includes plans for massive rehaul of the tax code and higher taxes for many clients. It's our job to plan and possibly act now for individuals specifically who might have more than $400,000 of income and make those elections and decisions now before the election occurs, just as a safety precaution. So what does that mean about increased taxes for those making $400,000 and up? Well, that seems to be where Biden is focusing his concern about income tax rates. Currently, somebody with a $400,000 income would be under a 37% tax code, and this was subject to the pre-tax cuts of the Jobs Act, where at that time tax levels for the highest wage earners were 39.6%. Also, under Biden's proposal, there's probably going to be a cap on itemized deductions to 28% of the value, which means anybody who's in a tax rate higher than 28% will face limited itemized deductions. There's also something called the P's limitation that Biden looks to reinstate. It was suspended through 2025 under the Tax Cuts and Jobs Act for people above $400,000. But again, if the P's limitation is put back into place, it would reduce itemized deductions by 3% of adjusted gross income in excess of the $400,000 threshold. As the law currently stands, there is a qualified pass-through business deduction, which allows small business owners to deduct up to 20% of their business income. These are capped at $163,300 for single filers and $326 for joint filers. However, for individuals and couples earning over these thresholds, there's just a ton of rules whether or not you are allowed to take the qualified business income deduction. Well, Biden's plan aims to simplify this by keeping QBI deductions in place for those with less than $400,000 in earnings, but phasing out deductions for those over $400,000. Lastly, Biden plans to impose a 12.4% payroll tax on income earned above $400,000, evenly split between employers and employees. This would create a donut hole in the current Social Security payroll tax, where wages between $137,700, the current wage cap, and $400,000 are not taxed. Currently, only $137,700 in wages are subject to the tax, which is 6.2, and the employers are required to pay another 6.2. In Biden's plan, those who are self-employed will carry the entire 12.4% themselves. Wow, that's a lot to absorb. Well, what kind of action should we be looking at based upon what could come to pass? Well, the first thing is accelerate income. If you anticipate to earn more than $400,000 per year, you may be able to save thousands of dollars if you accelerate some of that expected income into 2020. In addition, many people have bonuses that don't come in until the following year. It may make sense to pay out bonuses before the new year to save on ordinary income taxes and potentially Social Security taxes. Another strategy would be to push back deductions. If tax rates are expected to increase, the strategy is to push deductions to the following year so that you can offset income that would otherwise be taxed at the higher rate. A higher tax rate makes deductions more valuable, while a lower tax rate makes a deduction less valuable, and the deduction should be shifted either forward or backward to whichever year is anticipated to yield the highest tax rate savings. One that we've talked about a lot. Consider Roth conversions. Due to the potential large increase in taxes for those with income greater than $400,000, Roth conversions in 2020 can help defend against the potential for higher taxes, as well as potential for higher taxes for your heirs. In addition, this is an optimum time to project the tax cost on a conversion. Most people by this time have a reliable estimate of what their 2020 income will be. Some clients may think they'll be in a lower tax bracket in retirement. That doesn't often happen, especially after a spouse dies and the surviving spouse sees their tax bills increase when they begin to file as single. Even if it turns out taxes do not increase, which is unlikely, or that maybe taxes go even lower for some clients, even more unlikely, the tax rate on Roth distributions in retirement will be 0. That's not a bad worst case scenario. The bottom line is, if you have a large traditional IRA balance, a Roth conversion removes the risk and uncertainty of what future higher tax rates can do to your retirement income. And it makes sense to do that conversion now while rates are lower. This is a big one for most clients. Taxes on capital gains could dramatically increase. Capital gains taxes were reduced under the Tax Cuts and Jobs Act to 0, 15, or 20%, depending upon the taxpayer's income level. If Trump wins, this structure may likely remain the same, but under Biden's plan, taxes on capital gains could almost double to 39.6% for taxpayers with income over $1 million. So, again, what should we do? Well, let's accelerate some of those gains. With the great potential for increasing capital gains tax, it may make sense, if you have appreciated assets, to consider selling before the end of the year to lock in the more favorable tax rates. In addition, clients who are expecting a liquidity event or stock option sale in the future may want to consider doing that in 2020. Defer unrealized losses. Under a Biden tax plan, losses become more valuable. Taking a look at harvesting unrealized losses in stock portfolios could help to offset gains in other assets or create a tax deduction for those losses. Consider taking those losses in future years. Well, how about estate taxes? Well, likely to increase. Under the Tax Cuts and Jobs Act, Trump increased the gift and estate tax exemption from $5 million to $10 million, and now we're at $11,580,000 per individual, and this was inflation adjustments. Therefore, married couples at this point are able to transfer $23.16 million without incurring federal tax. Now, per Biden's proposal, he may reduce the exemption to a level closer to its historical norm. That could be around 5 million or even less. So what should we do if we're in that scenario where, our combined estate might be larger than 5 million over our lifetime, or over 10 for a couple? Gift now. For high net worth investors with estates valued at 10 million or more, use much of your lifetime exemption now rather than wait, as clients may only have 4 months left in 2020 to use the higher exemption. When gifting, the assets are no longer part of the estate, which helps to avoid gift and estate tax on all future appreciation of gifted assets, and the recipient, if they're in a lower tax bracket, that annual income earned on the asset will be taxed at a lower rate. A big thing is the IRS has agreed not to claw back any of the gifts, so consider making them in 2020. There's also something called a grantor retained annuity trust. Consider setting up a GRAT before the estate planning lifetime exclusion gets decreased and before GRATs are banned. This estate planning technique allows for the transfer of appreciated assets with minimal or no tax. With a GRAT, the grantor transfers assets into a trust for a term of year, and during the term, the grantor receives an annuity payment of either a fixed dollar amount or fixed percentage of the fair market value of the assets placed in the trust. If you would like more information on GRATs, please ask us or consult with your estate planning attorney. Here's another one that will affect a lot of folks. The cost basis step-up of gifted bequeathed assets may be eliminated. The current tax law states that heirs can receive appreciated assets with a step-up in basis to the asset's fair market value at the time of death. Therefore, appreciated assets can be transferred at death without capital gains tax liability. Biden is proposing to eliminate this step-up in basis at death, which could result in a big income tax bill at death. Gains will be recognized even if the beneficiaries don't sell the asset. This may create a huge tax liability that might force heirs to sell the assets to pay the taxes. So, what can we do? Well, one thing is decrease the size of estates. If the step-up in basis is eliminated, coupled with possibly the lower exemption ceiling, it's important to start thinking about how high net worth folks can get assets out of their estates before the laws are overhauled. Consider selling assets while still alive and paying the taxes, which is another form of gifting. Interest rates are at a record low, which makes accelerating gifting programs and repositioning assets key. If a client's been sitting on valuable real estate or business interests that are likely to appreciate, now is the time to consider gifting strategies such as a GRAT or charitable trust. Are you at risk? Given the possibility of significant tax changes heading our way, it's important to take advantage of the current laws and low tax environment. These tax changes could affect many Americans and especially the wealthy. With the election approaching, acting now may be crucial for reducing your taxes and the taxes of your heirs. If you have any questions or would just like to talk to us about your personal situation, please contact Prosperity Partners Wealth Management at area code 865-690-0049 or contact us at info.prosperitypartners.com. Thank you so much for tuning in, and we hope this information has been of value to you.